Good afternoon, everybody. Welcome back to my channel. I got another video today. This is a great video. I have a couple articles. Uh, I have a couple ETFs to discuss with you guys about. Normally, I talk about stocks to invest to for your particular dividend portfolio, but I have a treat. Ooh! So before we start, because I'm excited, before we start, like and subscribe to my channel. If you feel like I give you guys great value and understanding and stocks for you to do research to either pay your bills or for you to grow into a dividend portfolio or an investment portfolio for retirement. If you feel like I've been helping you guys out, hey, watch the video from beginning to end. Like and subscribe to my channel and show your boy love. Today we're going to talk about dividend aristocrats versus dividend contenders. Hey, it's the survival of the fittest. And so in the investing community, knows about dividend aristocrats or the stocks that's in the dividend aristocrats. What's considered a dividend aristocrat? But we're going to talk about what if you instead of investing to dividend aristocrats, which everyone always talk about, what about dividend challengers, dividend contenders? The stocks that been not only just been paying dividends, but been increasing their dividends for 10 plus years. The next tier that of stocks that's been reliable that can eventually move up the tier from dividend contenders to dividend aristocrats. The next tier of particular stocks that been increasing their dividends 10 plus percentage dividend growth stocks. If that excites you, then this is the video for you to watch. What is the difference between what is a dividend aristocrat? What's the criteria? What stocks are in the dividend aristocrats class? We're not going to talk about dividend kings because that's stocks that have been increasing their dividends 50 plus years, like J&J and Coca-Cola, and most recently Pepsi joined that class. We're going to talk about dividend aristocrats and dividend contenders. So if I've for my introduction, if that excites you, then come on, strap up. Okay, the S&P 500 dividend aristocrat. So what is a dividend aristocrat? So the requirements for to be a dividend aristocrat is three. So it's just right here. So a dividend aristocrat is a company in the S&P 500 index that has paid and also increased their dividend for a minimum of at least 25 years. So that's why honestly a lot of people love the dividend aristocrats because in starting a dividend portfolio from scratch, one of the main things and ingredients that people tend to rely upon is to focus on stocks that have been increasing their dividend for the past 25 years. So it shows stability. It shows industry or a company that's been has a track record of increasing profits, and with that, when you invest in these certain companies as you approach retirement, you feel a lot like you feel a lot more at ease that you've invested to the right companies because they've been consistent, they're stable, and then most importantly, they've also have a track record of 20 plus years of increasing their dividends. So you know that by investing in these dividend aristocrat stocks, that you don't have to worry about, for the most part, uh, them cutting the dividend. So it says, so for the requirements for to be a dividend aristocrat, it has to be in the S&P 500 index. It has to increase their dividends for 25 plus years. And the last part, the market cap and the cash flow minimums. It has to have a minimum flow adjusted market capitalization of at least 3 billion and average at least 5 million in daily share trading value for the past 3 months prior. Right here, it says as of January 5th of 2023, there were 64 dividend aristocrats. And as you see right here, here is as I slow down a list of the Dividend Aristocrats. Some Dividend Aristocrats you probably have heard of, and some you probably haven't heard of. So again, so uh, companies that have paid their dividend for companies that have paid and increased their dividend for 50 plus years are considered the dividend kings. So from here on up are considered dividend kings. So Target, uh, John J&J, uh, I know for a fact Pepsi had, yeah, Pepsi had made it this year. I know for a fact because when I was investing in Pepsi, um, you got also several other stocks that um, slowly approaching the 50-year mark, the lows, and as I see, McDonald's is 4 years out, right? And so if you're like Cadero, if you wanted to, um, and then so right here, uh, here are the stocks of 25 and plus or more they're in the dividend aristocrats class. So some stocks like um, the Extra, Caterpillar, A.O. Smith, Clorox, T. Rowe Price, Cintas, ExxonMobil. These are also Sherwin Williams, the paint company. So these stocks that you probably have heard of these different companies, and you probably haven't heard of these different companies. Down here, it goes into how the dividend aristocrats, how they are selected, and most importantly, total return. So um, total return because of these dividend aristocrats have been increasing their dividend for over 25 years. They have shown a consistency of increasing their dividend. So even in down markets like right now, when you are in a recession, when you're not receiving that share price appreciation due to interest rates going up, you still receive that dividend, and that dividend was what really helped in terms of the total return of the particular dividend aristocrats. And it's right here. It shows the dividend aristocrats ETF is called Noble, and then the S&P 500. Uh, it mirrors the index of SPY mirrors the S&P 500 index, and you see right here, for the most part, it's neck and neck, and so uh, it just shows right here where Noble, which is the S&P 500, Noble, which is the Dividend Aristocrats ETF, is a great alternative of investments that's stable, that's increases their dividend, and that produces almost neck and neck returns close to the S&P 500. Um, and then right here, it shows in terms of the dividend percent change. So that makes sense because in Noble it has different dividend stocks of ExxonMobil, Chevron, etc. Uh, but with the S&P 500, you're going to receive more bang for your buck in terms of share price appreciation due to the other tech stocks that's in the S&P 500 to give you those additional returns. So and then so also for here, I decided to show you guys Noble, which is the Dividend Aristocrats um, ETF. And so, yes, you can look at the Dividend Aristocrats list, and you can actually build a portfolio of single stocks, and you can pick and choose whether you want to have 5, 10, or 15. If you have the budget to build a dividend portfolio from scratch, or you can just buy one ETF and just call it a day. And so, right here, Noble, which is the Dividend Aristocrats ETF, costs $90 and 35 cents per share. Uh, what it has inside of the holdings, it's broken down 22% industrials, 21% consumer defensive, healthcare of 12.33%, So it's pretty it's heavy on industrials and consumer defensive, and then for the rest, it seems pretty balanced. And some of the top 10 holdings in Noble for of the Dividend Aristocrats ETF is WW Granger, Chevron, Nucor, ExxonMobil, Caterpillar, West Pharmaceutical, West Pharmaceutical Services, ADP. We all I know that they're dealing with payroll, and Franklin Resources. It has many other holdings, 65 holdings in total. And so for a lot of individuals that want to build a dividend portfolio from scratch, they look at the Dividend Aristocrats list, or you look at many different investing videos. They talk about Dividend Aristocrats, blah 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 blah. Right? I love Dividend Aristocrats. I'm not gonna say I don't, because I have several in my particular portfolio. But let me introduce you to the Dividend Contenders. Ooh, we now we talking. Now, what you're going to see is that uh, right here it says many think that the dividend aristocrats, the stocks that pay 25 years of consecutive dividend growth, first when considered this group, but there are a lot more stocks that's bubbling underneath the surface, and these stocks are called dividend contenders. The dividend contenders are companies that have been raising their dividend for the past 10 to 24 years. It's the tier before dividend aristocrats. Now, the reason why I'm bringing this up is because uh, I, to be complete honest, I invest into the dividend aristocrats stocks, and I love I have those McDonald's and Chevrons and stocks that have been playing 25 plus years in my portfolio, Lowe's, etc. But there's stocks in the first tier, which is the dividend contenders, that I love, and stocks that you'll see that um, tend to uh, give you more of a consistency of dividend increases of more than 10%. And I love this because it helps with the compounding, the long-term compounding of a dividend portfolio. Give you an example. And for the dividend contenders, for the 10 to 14 years, you have Home Depot, Amgen. So it's certain stocks that you'll see that's just I pop out from just my previous videos, or me talking about my portfolio, to giving the juice of my portfolio that it needs to increase my dividend portfolio's CAGR, compound annual growth rate. So you have stocks like BlackRock, UPS, Goldman Sachs, Hershey. Hey man, it's all about that chocolate, baby. It's all about that chocolate. But be serious, Hershey. You have in the next category stocks that companies that have increased their dividends for 15 to 19 years. Uh, I saw Union Pacific. I bought some Union Pacific early today. I have Best Buy in my portfolio. You have Prudential. You have Kroger. If you go grocery shopping, you see all the different Krogers. Kroger increases their dividend like roughly 22 or 20% last year. In the 20 to 24 years, you have Waste Management. What you gonna do with all that trash, right? You have Waste Management. You have Microsoft. Microsoft have been increasing its dividend for about roughly 10% for the past 20 years. Honestly, in the 20 to 24-year tier, these are the stocks that within another like within another depends on where they're at. Well, another 2 to 3 year increase is going to put them into the dividend aristocrat tier. And so you see Texas Instruments. I have this Qualcomm, Southern, Analog Devices, ADI. Remember that. And then also Nike. If you a ball player like soccer, basketball, football, Nike is where it's go. Why not invest into Nike? And so right here, if you could just see why I'm so excited is that the first tier of the dividend contenders have a lot of stocks or just a lot of companies that you very familiarized with that you may see on a day-to-day basis. For example, especially a UPS and Home Depot, that you're seeing that they've been increasing their dividends 8%, 9%, or 10+%. and that beats inflation. And also by investing in these different stocks, you hold it for, let's say, uh, 10 plus years. The stock is going to go from being a dividend contender to being a dividend aristocrat. So then you have a stock that has 20, 25, 30 plus years of dividend growth. And it would show its consistency, right? And so right here, it goes down, it breaks down that the whole pie chart of the dividend contenders. I love dividend contenders because um, it really, uh, they really be increasing their dividends for over 10%. I love it. And the ETF that corresponds with the dividend contenders is the Vanguard Dividend Appreciation ETF, which is VIG. Don't mistake it with VUG. VUG is Vanguard's growth ETF. So this is Vanguard's Dividend Appreciation ETF. It costs roughly $151.87 per share. But if you catch it on a good day like this, where when the Fed says whatever he says, you'll see that you'll see that you can probably get it for $150 per share, or even under $150. So it's a steal. And typically, VIG compared to Noble is that they both have low yields, but what you'll see is uh, lacking. You see, um, the advantage of this is the growth, the growth of the Vanguard's dividend appreciation. Look at some of the holdings. You have United Healthcare, J&J, Microsoft, J.P. Morgan, Visa. You have Home Depot, Mastercard. You have Coca-Cola. You have Broadcom. And so what you'll see is that these have a lot of stocks that have dividend yields under 2%, meaning that it's not going to give you more bang for your buck on the dividend paying aspect, but you're going to receive a lot more share price appreciation, and most importantly, total return. Total return is really important in your younger years. So as you build up the equity, so that if you want to employ the strategy of having increasing the total return, and then in your later years when you're 50, 55, 60, you can sell the portfolio of the total returns and then invest into more higher paying dividend stocks. So it's a particular strategy that people tend to use when they're younger, because why pay all those taxes when you're younger when you can just grow your net worth on paper? That's why people buy ETFs or index funds. Grow with the market, invest into the index, and then be rich on paper instead of uh, flossing, right? And so that's why people have like buy crypto and buy ETFs and index funds to be rich on paper. And remember, you 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 never if you in a loss, you didn't lose unless you sell. So as long as you hold on to something, and if you're down 20%, 30%, you technically didn't lose it unless you sell. Remember that. So right here with VIG on the last end, has a 1.93% dividend yield, has a 5-year dividend growth rate of 9.15%, and has been growing its dividends for the past 9 years. And so yeah. So all in all, for you guys, pick your poison. If you start a dividend portfolio from scratch, if you feel comfortable, just want to ride out stocks that have been increasing their dividend yields for 25 plus years. If the Dividend Aristocrats, if that criteria, and if since it has a lot um, more longevity and track record of showing of increasing dividends. If that's what you want to go down that route, you can. But hey, if what I've talked to you guys about today, if it interests you, if the dividend contenders, if you've seen these companies that have intrigued you, that you've seen on a daily basis, like Visa, Union Pacific, Kroger, Verizon, Costco, Best Buy, Home Depot, Hershey, which is a great dividend growth stock. that actually pays a nice dividend, but also has been growing a lot with the market. If you also wants to uh, invest into dividend contenders or do research in dividend contenders, hey, dividend contenders will not steer you wrong. So dividend contenders with Vanguard's appreciation ETF, VIG, or if you want to do just the aristocrats, dividend aristocrats of the 25 plus years, then you can just invest to Noble. So all in all, I'm going to pick and choose the dividend contenders route, and hopefully I was able to convince you to win you over to the dividend contenders side. But if not, then hey, you get to invest into Noble or the Dividend Aristocrats companies, or guess what? Or you can mix and match with your portfolio. Some Dividend Aristocrats like Lowe's and McDonald's, and some dividend contenders like Waste Management and Texas Instruments. So the choice is yours. Hope you guys enjoyed this video, the educational video, and hope you guys have a great day.